Picture this. You've been saving diligently for years. You've tucked away every bonus, every tax return, and even sacrificed those weekend getaways just to build your savings. Yet, when you finally decide to treat yourself, you notice that your hard-earned money doesn't stretch as far as you thought it would. Why? 2 words. Inflation exposed. Welcome to Wealth Builders Wisdom, where we decipher the enigmas of finance and guide you on a path to prosperity. Today, we're diving deep into the murky waters of inflation. We'll unveil the shocking truth behind the diminishing value of your money, and more importantly, how to counteract its effects. As time passes, you might notice the price of bread, gas, or even your favorite coffee gradually creeping up. That's not just because brands are getting greedier. It's a consequence of inflation, the silent eroder of your purchasing power. But what exactly is inflation? At its core, inflation is the rate at which the general level of prices for goods and services rises, causing purchasing power to fall. In simpler terms, it's why your grandparents could buy candy for just a penny, while you're stuck shelling out $1 for the same treat. However, inflation isn't just an arbitrary phenomenon. There are forces at play that influence its rise and fall. Central banks, government policies, supply chain disruptions, they all play their part. Now, midway through our deep dive, if you're finding this content beneficial, do us a favor and hit that subscribe button. Join our Wealth Builders Wisdom community and ensure you never miss out on such enlightening content. So where does inflation come from? Well, imagine a scenario where there's too much money chasing too few goods. When demand exceeds supply, prices go up. This can be due to an increase in production costs or an increase in consumer demand. Then there's hyperinflation, which is inflation gone wild, where prices increase by 50% or more in just a month. It's as chaotic as it sounds and has catastrophic implications for economies. But not all is doom and gloom. Controlled moderate inflation is actually desired by many economies. It indicates growth. When people are buying more, prices rise, and businesses can then hire more, pay more, and invest more. The trick is balancing this delicate dance. However, for the individual saver and investor, inflation can be a tricky beast. If the inflation rate surpasses the interest rate you're earning on your savings, you're actually losing purchasing power over time, that's right. Your money in the bank, if not invested wisely, is shrinking in value. So what can you do? Diversification is key. Consider investments that historically outpace inflation, like stocks, real estate, or certain commodities. Moreover, be strategic with your savings. Consider high-yield savings accounts or bonds that might offer better returns. But remember, it's not just about dodging the inflation bullet. It's about understanding the financial landscape, being proactive and making informed decisions. Knowledge is power, and with the right strategies, even in the face of inflation, you can continue to build and protect your wealth.
George started years ago. When I started teaching this stuff, I was first teaching people how to get out of debt, live on a budget. Be generous. Live on less than you. Make sure you have a plan. You avoid debt. You save money for emergencies, and later for investing. Kept saying, which one do I do first? But I figured out in personal finance that the data of best practices among millionaires doesn't necessarily follow math all the time. In other words, personal finance is more personal than it is finance. It's more behavior than it is math. And so what?
As we wrap up this enlightening journey, it's crucial to remember that the world of finance is ever evolving. Staying informed, continuously learning, and adapting your strategies is the key to not just surviving, but thriving. Let's take a step back and get into the nitty-gritty. You might be thinking, how is inflation measured? The answer is through a Consumer Price Index, or CPI. This index evaluates the average prices of a basket of consumer goods and services, like transportation, food, and medical care. Over time, by tracking these prices, we can measure the inflation rate. Another concept closely tied with inflation is the cost-push inflation. It's when costs to produce goods and services increase, and businesses then pass on those costs to consumers in the form of higher prices. This could be because of increased costs of raw materials or wages. Then there's demand pull inflation. This arises when the demand for goods and services exceeds their supply. It can be triggered by increased consumer spending due to lower interest rates, increased government spending, etc. Ever wondered why some countries have rampant inflation while others seem stable? Another aspect worth exploring is the wage price spiral. This phenomenon occurs when wages increase and businesses then raise their prices to offset the wage hikes. Workers, in turn, demand even higher wages as the cost of living goes up due to the raised prices. This cyclical process can further fuel inflation. It's important to note that not all inflation is bad. Mild inflation can signal a healthy economy, encouraging spending and investment. Conversely, deflation, which is a decline in prices, might sound good on the surface but can lead to reduced consumer spending as people wait for even lower prices, stalling economic growth. Remember, the key lies in balance and understanding the broader economic picture. By staying informed and proactive, you can turn financial challenges into opportunities, ensuring a brighter financial future.